listen up, because what just went down at the World Economic Forum is about to change everything you thought you knew about money. We're talking tokenization, stable coins, and a financial war that's brewing between the US, China, and Europe, and XRP is right in the middle of it all. Welcome back to the channel. This is part 2 of the explosive World Economic Forum discussion featuring Brad Garlinghouse from Ripple and Brian Armstrong from Coinbase. If you missed part 1, go back and watch it now because things are about to get intense. Today we're diving deep into the battle for the future of finance. And trust me, you need to hear this. Now before we jump in, smash that like button. Drop your thoughts in the comments below. And if you're not subscribed yet, hit that subscribe button for more XRP and crypto content. Let's get into it. The conversation kicks off with a critical point about democratization of markets. When innovation hits an asset class, everyone talks about giving people access. But here's where it gets interesting. We're witnessing a massive shift toward alternative investments, and tokenization is the vehicle driving this transformation. One of the panelists brings up something fascinating about market maturity. As the market evolves, people aren't just looking for innovation anymore. They want trusted parties who can provide safety while bridging different liquidity pools. This is where financial market infrastructure becomes absolutely crucial. We need interoperability between these different pools of liquidity and traditional finance. That's the real value proposition here. Here's something that should grab your attention. European savers exist, but European investors? Not so much. The instruments available haven't evolved fast enough to attract these people. This is where tokenization and alternatives come in. They could be the key to making European capital markets more attractive. And here's the kicker. It's all about complementarity between Bitcoin, traditional finance, and everything in between. This is massive for the growth of financial markets. Now let's talk about something controversial: yield. Gold has been incredibly attractive, but it doesn't pay yield. Meanwhile, there's a regulatory battle brewing in the United States, and Brian Armstrong from Coinbase is right in the middle of it. The Clarity Act has hit some roadblocks thanks to opposition from major players, and the debate is centered around whether tokenized assets should pay rewards, almost like dividends. And get this, China is pushing ahead with a revamped yuan that actually pays dividends. So why is this necessary? Is it just pushing the agenda for companies like Coinbase, or is it genuinely good for consumers? Brian addresses this head-on. Legislation in the US has been making solid progress on market structure. Despite what some people think, it's not stalled, it's going through a healthy round of negotiations, and that's actually positive. But here's what Coinbase is concerned about. They want to make sure any crypto legislation doesn't ban competition for traditional financial services or securities brokerages. According to their reading of the draft, it actually unfairly penalized crypto companies. They believe everyone should be able to compete on a level playing field, because that's when consumers benefit. Make sure you're still with me here, because this next part is critical. Drop a comment below and tell me what you think about stablecoins paying interest. And if you haven't liked the video yet, do that now. It really helps the algorithm push this content to more people who need to see it. There are two main reasons why stablecoins paying rewards matters. First, it puts more money in consumers' pockets. People should be able to earn more money on their money. That's just basic fairness. But second, and this is huge, it's about global competitiveness. China just announced their central bank digital currency is going to pay interest. Meanwhile, offshore stablecoins are actually larger than US regulated ones right now. Those offshore players would love it if US stablecoins were banned from paying rewards because it would allow them to flourish without competition. From a US legislator's perspective, they should be ensuring that US regulated stablecoins remain competitive. The same goes for Europe. Eurocoin and others need to grow, and we're in a global competition. Each country needs to put their interests first while ensuring consumers benefit. Now here's where the banks come in, and this is where things get really interesting. What's happening behind the scenes is that banks are putting their thumbs on the scale trying to eliminate their competition before they actually have to compete at scale. They're worried about money flight. Right now, a lot of people have their money sitting in banks, but if there's this new regulated market over here where you're getting an extra 2, 3, or 4% and it's all regulated, you might move your money to wherever you're getting the best return. Think about it. If you're saving money and getting 0.25% at your bank, but you could be getting 3 or 4% from Coinbase or Uphold, of course you're going to choose the higher return. Banks are terrified of that money leaving the banking system because if it does, how can they loan and do all the other things banks need to do to stay in business? This brings up a fascinating question that gets posed to the European Central Bank governor. Does the digital euro need to pay interest? And the answer is surprising. The governor says no, and here's why. He's tired of this apparent opposition between innovation and regulation. There's this idea that Europe is only about regulation, while the US is all about innovation. While there's an apparent contradiction, there's a common purpose in the long run, and that's trust. Regulation without innovation, that's status quo statism. Nobody wants that. But innovation without regulation could create serious trust issues. Financial crises are born from misguided or dangerous financial innovations, and they have a very high cost. That's why we need regulation. The key is finding the right balance. When it comes to the question of remuneration for stablecoins or central bank digital currencies, they're looking at the effect on financial stability and the banking system. The digital euro isn't intended to attack the banking system and its deposits. The governor strongly believes in complementarity between public and private systems. This has been the monetary system for centuries. It's a change of technology today, but not a change of principle. Brad Garlinghouse jumps in here, and remember, he's the innovator in the room who also believes in regulation. He points out that what's happening in the US right now is a classic dynamic of when you create new law. It's never going to be perfect. He subscribes to the idea that perfection is the enemy of good. You can't get to perfection. And here's something powerful. Ripple lived through a 5-year battle with the US government, getting sued because of the lack of clarity. So they're huge advocates for the principle that clarity is better than chaos. They're very close to achieving that clarity now. On the question of rewards, dividends, or interest on stablecoins, Brad admits Ripple doesn't have as much stake in that fight as others in the industry, but he agrees that competition is good and supports the idea of a level playing field. However, he makes an important point. A level playing field goes both ways. Crypto companies should be held to the standards that banks are held to, and banks should be held to the standards that crypto companies are. It's not a one-way street where Team Crypto gets a free pass. Before we continue, I want to hear from you. Subscribe and comment below with your prediction. Will stablecoins paying interest become the standard? And do you think banks are right to be worried? Let me know in the comments. The banker on the panel, Bill, brings a pragmatic perspective. Money goes where there are returns and where there's the best option. His bank operates across major corridors in Asia and Europe, so he's dealing with digital yuan and various other digital currencies. His take on tokens is brilliantly simple. Tokens are going to be used for two things. First, as a medium of exchange. No particular need for them to bear interest because they'll be instantly transmitted. Second, as a store of value. And as a store of value, they're much less interesting if they don't carry yield. There will be stable coins, tokenized bank deposits that probably bear yield, and tokenized money market funds that will definitely bear yield. That's the whole point. Right now, stablecoins are big and liquid. Central bank digital currencies don't exist yet at commercial scale. Maybe they will, maybe they won't. Tokenized money market funds in currencies like Hong Kong dollars or Chinese yuan will exist and be useful as stores of value. His research estimates, and everyone has their own numbers, that we could hit $3 trillion of outstanding stablecoins in the next 3 or 4 years. Here's the key insight. The bulk of that is going to be in developing economies where there's lack of confidence in the local currency. Table coins of whatever form or Bitcoin will be used as stores of value. Bitcoin is volatile. Everybody knows that. The US dollar, you like it or you don't, but you know what it is. So that money is going into stablecoins today. It may go into tokenized money market funds in the future if they're available and bearing yield. As a bank, they don't care which one consumers choose. They want their customers to get the best thing for them. If it's a medium of exchange, they want to provide the entry and exit points. They do that today. Customers appreciate it, and they'll keep doing it. When it comes to store of value, especially in emerging markets, it's got to be compliant. There's probably a black market transaction somewhere getting local currency out into US dollars. Sometimes it's legitimate, sometimes it's not. That's always been an issue. As a bank, they're essentially policemen trying to prevent financial crime, though unfortunately banks don't prevent most financial crime. There's an important conversation to be had about regulation here. It's not going to be perfect for one side. You're going to have to give while the other side gets. You need compromise, so both sides feel they got something. If it goes a certain way, Coinbase might have to change some things they're doing. That's just the name of the game. If we want to push forward with regulation and innovation in the United States, it might not be perfect, but this is what's needed to move it forward. The industry will need to change or react to whatever regulation passes. This is exactly why banks and financial institutions haven't gone full throttle into using crypto yet. They don't want to jump in if regulation passes, and what they've specifically built and invested millions of dollars into becomes illegal. So they're waiting. Once regulation drops, there's a rulemaking period that could take years. Look at MiCA in Europe. It already took them a year and a half to do most of their rulemaking, and they're still at it. In the US, we haven't even started yet for crypto. This brings up a critical question about European competitiveness. If we're talking about different regulation and different approaches, is Europe going to be left behind? The response is optimistic. Europe has to accelerate, and 2025 has been a year where everybody realized there's a need for fair competition, a level playing field, and acceleration in innovation. There's willingness in Europe to make this happen. In the securities business, companies like Euroclear have a global footprint. They've been pioneering the issuance of digital assets for about 4 years. They're seeing value in tokenization, especially for collateral management. One thing they're really adding to financial markets is liquidity. If you can increase the liquidity and movement of collateral through different pools, that benefits the entire capital markets ecosystem. Now, here's a geopolitical angle that's absolutely crucial. We've got so many stablecoins backed by US dollars. The yuan is moving at pace as well. What's the reality of the future if there are more transactions in both of these currencies, bypassing other elements? Does that have consequences for the relevance of the euro and other currencies? Brian Armstrong addresses this directly. They're absolutely in global competition. China, US, Europe, going down the list to Japan. In some ways, Europe is ahead of the US because they passed MiCA legislation. They have comprehensive crypto legislation, while the US only has about half of it done right now with the Stablecoin Act, and they're still working on market structure. So Europe is ahead in that sense, but the vast majority of stablecoins are still US dollar backed. When Brian meets with leaders in Europe, he encourages them to move faster and allow things like rewards on stablecoins, which is different from interest and yield, that would allow them to be globally competitive. He'd like to see Europe move faster on European stablecoins. The governor brings up sovereignty and geopolitical balance, noting that everyone on the panel is from advanced economies. This development of tokenization is probably an increasing challenge for developing countries or emerging economies because it could mean full dollarization. On the other side, it will bring serious cost savings on cross-border business, which is a huge benefit for the developing world. But the worry about tokenization is bigger in the global south. There have been discussions in the G20 with important emerging countries saying they should forbid cryptos, which the governor thinks is not a good solution because we'd lose innovation. But the issue exists. Tokenization is probably an accelerator of the diversification of the monetary system and diversification of currencies. At present, most stablecoins are in dollars for a very simple reason. It's linked to the main use case, which is crypto exchanges. But if we move to financial transactions and even more to economic transactions, we'll see diversification. Infrastructure will matter significantly here. Someone from the audience asks an important question about credit leverage, duration transformation, and monetary policy in a world where stablecoins win the game. The governor points to Brazil as an interesting example. Brazil developed a fast payment system called PIX, which is probably the most efficient system out there. Everyone uses it. Go to any pharmacy or bakery in Brazil and everybody's using PIX. It's super easy and super fast. If stablecoins only win the game, that would mean money is completely privatized. The governor wouldn't be completely reassured, to put it mildly. We've had examples in the past where money was completely private without a serious central bank. Look at what existed in the US in the 19th century. There was no real Fed or central bank, and there were many crises of confidence. Central bank currency might not be dominant or have a significant market share, but it's an anchor of confidence. That's why complementarity is so important. It's in the interest of stablecoins to be fully equivalent at par, one-to-one without fees, to a central bank currency. Brian adds that in a world where stablecoins grow significantly, they wouldn't be entirely private money. In the US, under the Genius Act, all stablecoin reserves have to be held in short-term US treasuries. So they're really backed by US treasuries, but the token is privately issued. What will happen is companies will have a 100% reserve of people's money held in US treasuries. There won't be a concept of fractional reserve if they don't want to get licensed as a bank. People can earn rewards on those stablecoin balances, but if they want to earn a higher return, customers can opt into lending out their money. That would have to pay a higher rate than what they could get in short-term US treasuries. It actually flips the banking model on its head. Someone asks a basic but important question about electricity and compute power. Tokenization is built on blockchain technology, and blockchain requires compute and electricity. Given that we already have capacity issues covering all the AI developments, how are we going to cover all the tokenization that's coming? Brad addresses this perfectly. Not all layer 1 blockchains are created equal. Some use proof of work, some use proof of stake, and some use other consensus models. You can't uniformly put all blockchain infrastructure in one power consumption category. It's not as big a deal as people think. Most of the stablecoin activity today is on more power efficient blockchains, either proof of stake or other consensus mechanisms. You've got Hedera, which is carbon neutral. You've got the XRP ledger and many other blockchains that don't require massive electricity consumption. Solana, XRPL, Hedera, they all fit the same efficient profile. Proof of stake uses 99.9% less energy than proof of work. Most tokenization is happening on the Ethereum blockchain, which uses proof of stake. Another fascinating question comes from the founder of the largest non-bank payments company in Latin America. He asks why countries in the global south that don't control their own currency haven't moved on-chain already. What needs to happen to move their whole payment infrastructure to blockchain and perhaps have stablecoins replace the dollars they use locally? The answer reveals the sovereignty concern. Most developing economies, not all, but most, are still resisting giving up currency sovereignty. Some countries have gone entirely digital and given up sovereignty. Others have accepted dollarization and given up sovereignty. Most resist for the reasons discussed earlier. So it happens through the back door, and you end up with a de facto dollarized system. These systems actually work. They're not bad at all, but the government loses an extremely important lever of power. These aren't typically democracies. Though they may be in some cases, the government loses a lever to control the destiny of their people, which typically isn't popular with the people. If it doesn't happen through the front door, it happens through the back door. But the better outcome by far is to have a legitimate monetary regime managed by a legitimate central bank. The governor adds a positive note. Many emerging countries and developing economies are very innovative in fast payment systems. They're more focused on the infrastructure side than the currency side itself. Advanced economies aren't the most innovative in fast payment systems. Look at UPI in India or South Africa. There are very interesting things happening on payment systems in developing economies. Here's a critical question that impacts everyone. If we have more fractional ownership through tokenization, does that drive speculation? We've seen this in many areas where fractional ownership exists. Retail investors getting involved often leads to escalation of that asset class. Think about single homes. There was a recent announcement from the president trying to keep out institutional ownership. Could that be a preemptive strike ahead of tokenization changes? Does it provoke more speculation in asset classes? And where does it leave the average owner? Brad pushes back on the word speculation. He subscribes to Brian Armstrong's earlier comment about opening up investment access. Investment versus speculation are two different buckets. They both have a purpose and active market participants. The opportunity around tokenization for certain verticals is the democratization of access to investment, less so the speculation side. If you want economic exposure or investment exposure to a commercial building in Miami and you have $10,000, you can't do that today. Opening that up is the real opportunity. The banker brings up transparency. Investment or speculation are two sides of the same coin versus transparency. In a fractionalized world, you'd have much more transparency. Transparency is typically good for systemic stability in the long run, although it can lead to bubbles or bouts of short selling that induce volatility. On balance, where we've had nasty financial crises, they've been when there were problems some in the market saw but couldn't act on and couldn't normalize. He'd always vote for transparency, and fractionalization should lead to transparency. The governor adds that yes, we should increase access to investment, but it must go along with increased awareness of risk. This is about advice by the financial industry to customers and financial literacy. It should go together. If not, it could be catastrophic at the end. Before we wrap up, make sure you've hit that like button and subscribe to the channel. Drop a comment and tell me, do you think tokenization and fractional ownership are the future, or are we heading toward too much speculation? I want to hear your thoughts. The panel agrees it's two sides of the same coin, and it depends on people's risk profiles. Access doesn't necessarily mean speculation. One panelist takes a different angle. The top 10 fiat currencies of the world will have enough trust to persist, and the next 100 should either get dollarized or replaced by Bitcoin. That's a bold prediction about the future of money. These conferences happen once a year, and they're incredibly important. We're having conversations about what the future is going to look like. We have all sides represented here: innovators, regulators, bankers, and central bank officials. This is valuable content that gives you context and helps you understand what the future looks like for XRP, for the rest of the crypto market, for stablecoins, for fractional real estate and other products, and for opening up access to the 4 billion people who don't have access to current markets. This is really going to help everybody invest in whatever they want at any time in their life. That's going to help people get to where they want to be, an established life and hopefully early retirement. The transformation we're witnessing isn't just about technology. It's about financial inclusion, global competitiveness, and reshaping the entire financial system for the digital age. The battle lines are drawn between the US, China, and Europe. Each region is taking different approaches to regulation, innovation, and implementation. The companies leading this charge, Ripple, Coinbase, and others, are navigating complex regulatory environments while trying to maintain competitive advantages. Banks are trying to protect their turf while also recognizing they need to adapt or be left behind. What's clear is that tokenization isn't a question of if, but when and how. The infrastructure is being built, the regulations are being negotiated, the competition is heating up, and XRP, along with other blockchain technologies, is positioned right at the center of this transformation. Whether it's payment rails, stable coins, or tokenized assets, the next few years are going to be absolutely critical for determining winners and losers in this new financial landscape. Thanks for sticking with me through this deep dive. If you got value from this breakdown, hit that like button one more time, share this with someone who needs to understand what's coming, and subscribe for more XRP and crypto content. I'll see you in the next one.